I was reviewing our latest client portfolios last week when something stopped me cold. A 58-year-old investor, let's call him Robert, had just made a decision that I've seen destroy more retirement plans than any market crash ever has. He'd sold his entire bond portfolio. All of it. His reasoning? Bonds are for old people, Howard. I've got time. I'm going aggressive. Here's what Robert didn't know. He had exactly what I call dangerous optimism. Not the good kind that keeps you invested through volatility. The bad kind that makes you forget you're not 35 anymore. I'm Howard Marks. I've been managing money since 1969, back when calculators were the size of briefcases, and diversification meant owning both IBM and AT&T. I've watched thousands of investors navigate the transition from accumulation to preservation. And I've seen 5 specific mistakes that separate those who retire comfortably from those who don't. These aren't the obvious mistakes everyone warns you about. They're subtler, more insidious. And if you're over 50, they're probably costing you more than you realize. Let me show you what I mean. The first trap is what I call fighting the last war. And it's everywhere right now in 2025. Think back to what happened between 2010 and 2021. If you own stocks, any stocks really, you made money. The S&P 500 went up year after year. Corrections were brief. Dips got bought. Everyone learned the same lesson. Buy the dip, hold forever, get rich. That lesson is now hardwired into an entire generation of investors. And if you're over 50, it might be the most dangerous thing in your head. Here's why. When I started in this business, the investors who'd lived through the 1930s couldn't bring themselves to own stocks. They'd learned that stocks could go to zero and stay there for decades. They were fighting the last war, the Depression. And they missed one of the greatest bull markets in history. Today's version is the opposite, but equally destructive. Investors who lived through 2010-2021 can't imagine a world where stocks don't bail them out. They've learned that every dip is a buying opportunity, that cash is trash, that bonds are for suckers. But markets don't repeat, they rhyme. And the rhyme scheme is changing. I'm watching investors in their 50s and 60s maintain portfolio allocations that made sense when they were 35. 80% stocks, concentrated positions in tech, minimal fixed income. They're positioned for a world that rewarded aggression and punished caution. But that world is shifting. Consider what's different now. Interest rates have normalized. The Fed isn't backstopping every market hiccup. Valuations are elevated by historical standards. The easy money has been made. This doesn't mean stocks will crash. I don't make predictions like that. But it does mean the risk-reward equation has changed. And if you're 55, with a portfolio built for a 35-year-old in a 2015 market environment, you're fighting the last war. The cost? I've calculated it. An investor who maintains an aggressive allocation appropriate for someone 20 years younger then gets forced to de-risk after a 30% drawdown, which happens on average every 10 to 15 years, locks in losses they'll never recover. The math works out to roughly $200,000 on $1 million portfolio over the remainder of their investing lifetime. That's not a market loss. That's a strategic error. The second trap is more psychological, and it's the one that keeps me up at night when I think about our clients. I call it mistaking a bull market for genius. Over the past 15 years, being aggressive worked. Buying technology stocks worked. Ignoring bonds worked. Staying fully invested worked. And here's the dangerous part. It worked so consistently that investors started believing they'd figured something out. I see this in every conversation I have with investors over 50 right now. There's a confidence that wasn't there in 2009, a certainty that wasn't there in 2002. They've made money. They've outperformed their neighbors. They've proven the cautious investors wrong. But they haven't proven anything. They've just been present during a period when their strategy happened to align with market conditions. Let me tell you something I learned in the 1990s. I watched investors, smart people, successful in their careers, convince themselves they'd mastered technology investing. They'd bought Cisco, watched it go up, bought more, watched it go up more. By 1999, they were certain they understood something others didn't. Then 2000 happened. And it turned out they hadn't understood anything. They'd just been holding the right assets at the right time. The distinction matters enormously when you're over 50. Because when you're 30, you can recover from confusing luck with skill. You have time, you have income, you can rebuild. When you're 55, you don't have those luxuries. A major loss at 55 doesn't just set you back, it can end your retirement plans entirely. Right now, I'm watching investors in their 50s who've done well over the past decade, making the same mistake those tech investors made in 1999. They're extrapolating recent success into the future. They're increasing their risk exposure because it's worked. They're becoming more confident precisely when they should be becoming more cautious. And the market will eventually teach them the same lesson it taught those tech investors in 2000. The lesson always comes. The only question is whether you can afford to learn it at your age. The third trap is subtler, but it might be the most expensive of all. I call it the income illusion, and it's based on a fundamental misunderstanding of how wealth compounds after 50. Here's what I mean. When you're building wealth in your 30s and 40s, income from your portfolio doesn't matter much. You're not spending it, you're reinvesting it. What matters is total return, growth plus income, all compounded. But something shifts in your 50s. You start thinking about income differently. You start looking at dividend yields. You start calculating how much your portfolio pays you. And that shift in thinking, that focus on income, can cost you hundreds of thousands of dollars. I see this constantly. An investor comes to me with a portfolio of high dividend stocks, utilities, REITs, telecom companies. I'm set up for retirement, they tell me. I'm getting 4% yield. Then I show them what they've given up. Because here's what most investors don't understand. Companies that pay high dividends today often do so because they can't reinvest that capital profitably. They're mature businesses, slow growth businesses, sometimes declining businesses. Meanwhile, the companies that pay low or no dividends, the ones that reinvest their cash flow, are often the ones generating superior total returns. Not always, but often enough that the pattern matters. I'm not against dividends. I'm against organizing your entire portfolio around current income when what you really need is total return. Because here's the reality. Whether your portfolio generates a 4% return through dividends or through a combination of 2% dividends and 2% appreciation makes no difference to your wealth. But the portfolios that focus on high current income often underperform on total return. And that underperformance compounds. Over 10 years, a portfolio yielding 4%, but growing at 6% total return, will underperform a portfolio yielding 2% but growing at 8% total return by more than $200,000 on $1 million starting balance. That's the income illusion. You feel like you're being smart and conservative by focusing on income, but you're actually being penny wise and pound foolish. The fourth trap is about timing, and it's the one that catches even sophisticated investors. I call it the retirement risk zone. And if you're between 55 and 65 right now, you're in it. Here's the problem. The decade before retirement is the most dangerous period of your investing life. Not because the market is more volatile, it isn't, but because the impact of volatility on your retirement outcome is maximized. Think about it this way. If you're 35 and the market drops 30%, it's annoying. You might lose a year or two of gains, but you keep contributing. You buy the dip, you recover. If you're 75 and the market drops 30%, it's concerning. But you've already retired. You've already sized your spending. You adjust, but the damage is contained. But if you're 60 and the market drops 30%, that's catastrophic. You're at your peak wealth. You're about to stop contributing. You're about to start withdrawing. And now your portfolio is 30% smaller right when you need it most. I've seen this destroy retirement plans. An investor reaches 60 with $2 million. They're planning to retire at 65. Then the market drops 30%. Now they have $1.4 million. They panic. They sell. They miss the recovery. By 65, they have $1.5 million instead of $2.8 million if they'd stayed invested and the market had recovered. But here's the thing. They can't afford to stay invested because they're in the retirement risk zone. They don't have time to recover. They need that money soon. This is why I've become obsessed with what I call tactical de-risking for investors in their late 50s and early 60s. Not market timing, not trying to predict crashes, just gradually reducing exposure to assets that could have catastrophic drawdowns right when you can least afford them. Most investors do the opposite. They stay aggressive through their 50s because they're still accumulating. Then they de-risk suddenly at retirement. That's backwards. The time to de-risk is before you need the money, not when you need it. I've calculated the cost of getting this wrong. An investor who maintains an aggressive 80-20 stock bond allocation through age 60, then experiences a major drawdown and is forced to lock in losses, will end up with approximately $200,000 less at age 70 than an investor who gradually shifted to 60-40 starting at age 55, even if both experience the same market returns. The difference isn't the returns, it's the sequence. It's the timing. It's understanding that when you're in the retirement risk zone, protecting what you have matters more than reaching for what you might gain. The fifth trap is the one I see most often, and it's the hardest to fix because it's rooted in something admirable: optimism about the future. I call it the longevity gamble, and it goes like this. I'm healthy. My parents lived into their 90s. I've got time. I can stay aggressive.
Here's why that logic is dangerous.
Yes, you might live to 95, but you also might not. And even if you do, the question isn't how long you'll live, it's how long you'll be able to actively manage a portfolio, make complex decisions, and handle volatility without making emotional mistakes. I'm 79 years old. I'm still working. I'm still writing memos. I'm still making investment decisions. But I'm the exception, not the rule. And even I know that my ability to handle complexity and stress isn't what it was at 55. Most investors experience a decline in financial decision-making ability starting in their late 60s. Not because they're not smart, but because the part of the brain that handles complex risk assessment and emotional regulation changes with age. It's biology, not intelligence. This means that if you're 55 and planning your portfolio for a 40-year time horizon, because you expect to live to 95, you're making a critical error. You're not planning for 40 years of active, sophisticated investing. You're planning for maybe 15 years of that, followed by 25 years of simplified, lower maintenance investing. And that changes everything about how you should be positioned today. I see investors in their 50s maintaining complex portfolios with dozens of positions, alternative investments, concentrated bets, and sophisticated strategies. They're planning to manage this actively for decades. But the reality is that by their mid-70s, most of them will have simplified dramatically, either by choice or by necessity. The cost of not planning for this? I've seen it repeatedly. An investor maintains a complex, aggressive portfolio through their 60s. By their mid-70s, they can't handle the complexity anymore. They hand it to an advisor who simplifies it, often selling at inopportune times and locking in tax consequences. Or they make emotional decisions during volatility that they wouldn't have made when younger. The solution isn't to give up. It's to start simplifying and de-risking now, while you still have the cognitive capacity to do it thoughtfully rather than reactively. A portfolio that's 70% stocks and 30% bonds, rebalanced annually in low-cost index funds, will outperform a portfolio that's 85% stocks and 15% bonds in complex, actively managed strategies. Not because of the allocation, but because the simpler portfolio is easier to maintain as you age. You won't make mistakes. You won't panic. You won't need to rely on diminishing cognitive resources to manage it. Now, I know what some of you are thinking. Howard, this all sounds conservative, defensive, maybe even pessimistic. And you're right, it is conservative. But conservative doesn't mean low return. It means appropriate risk. And appropriate risk for someone over 50 is different than appropriate risk for someone under 40. Here's what I've learned after 56 years in this business. The investors who retire successfully aren't the ones who took the most risk. They're the ones who took appropriate risk and avoided catastrophic mistakes. And these 5 traps? They're the catastrophic mistakes I see most often among investors over 50. Fighting the last war. Mistaking a bull market for genius. Falling for the income illusion. Ignoring the retirement risk zone. Making the longevity gamble. Each one on its own can cost you 6 figures. Together, they can be the difference between the retirement you planned for and the retirement you can afford. So what do I do about this at Oaktree? How do I think about portfolio construction for investors in their 50s and 60s? 3 principles guide everything. First, I focus on what I can control. I can't control returns, but I can control risk. I can control costs. I can control tax efficiency. I can control simplicity. Those 4 factors, risk management, cost minimization, tax efficiency, and simplicity, matter more after 50 than they did before. Second, I think in terms of probabilities, not possibilities. Yes, it's possible your portfolio could compound at 12% for the next 20 years. But what's probable? What's the range of outcomes? And are you positioned to survive the lower end of that range? Third, I remember that the goal isn't to maximize wealth, it's to ensure sufficiency. Once you have enough to fund your retirement comfortably, taking additional risk to accumulate more becomes irrational. You're risking what you have and need for what you don't have and don't need. That's not investing. That's gambling. I started this by telling you about Robert, the 58-year-old who sold all his bonds. Here's what I told him. You're not investing for maximum return anymore. You're investing for maximum probability of achieving your goals. Those are different objectives, and they require different strategies. He didn't love hearing it. Nobody does. We all want to believe we're the exception, that we figured something out, that the rules don't apply to us. But they do. They always do. And the investors who accept that, who adjust their strategy to match their stage of life, are the ones who make it to the finish line with their wealth intact. I hope this helps you think differently about your portfolio. Not more pessimistically, just more realistically. Because realism, in investing, is the closest thing we have to a superpower. Thank you for your time.